The stock market is currently closed, and as of the final bell on Tuesday, June 23, 2026, Nokia OYJ, trading under the ticker symbol NOK on the New York Stock Exchange, finished the regular session at exactly $13.70 per share. This represents a drop of 5.06% during intraday trading, pulling back from its previous close of $14.43. This sharp downward move came on a heavily elevated volume of over 84 million shares swapping hands, indicating a massive wave of active institutional repositioning. The immediate surprise here is that this slide happened right after a major 7% surge on Monday, triggered by an official expansion of Nokia's partnership with Google Cloud to integrate Gemini large language models into its carrier network software. Retail participants observing this volatility through their Robinhood stock trading interface or checking their watch lists on the Fidelity mobile app might see this pullback as a sign of weakness, but the deeper reality reveals a structural transition. The company is actively shifting from a low-margin hardware supplier into a high-margin data center infrastructure and automated network intelligence software provider, which completely alters how long-term capital needs to evaluate the equity. The common ground shared by most market participants is the belief that Nokia is an old telecommunications dinosaur, permanently tethered to the slow-moving capital expenditure cycles of major global mobile carriers. People look at their self-investing portfolios and group Nokia with stagnant legacy industrial names, assuming its growth is capped by the sluggish rollout of regional wireless infrastructure. The contrarian take that forces a complete rethink is that Nokia is quietly building the underlying physical architecture required for artificial intelligence clusters, specifically through its high-capacity optical networks and silicon photonics developments. While retail interest remains heavily concentrated on high-flying megacaps like Nvidia stock, Apple stock, or Tesla stock, sophisticated institutional money is actively looking for secondary infrastructure plays that trade at deep discounts. When artificial intelligence clusters expand, they require an immense amount of bandwidth and near zero latency to move data between thousands of graphic processing units, and that is exactly where Nokia's routing and optical transport systems come into play. The expectation was that Nokia would remain trapped in a cyclical telecom downturn, but the reality is that their enterprise and cloud data center segment grew 49% year-over-year in the first quarter of this year, recording over €1 billion in fresh infrastructure orders. Analyzing the recent daily swings in trading volumes reveals a battleground between short-term macro-driven selling and long-term accumulation by major funds managing individual brokerage accounts. The drop to $13.70 highlights the broader macroeconomic pressures affecting the technology hardware sector, including higher-for-longer interest rates and tighter capital budgets among traditional telecommunications service providers. Institutional activity has shown a distinct pattern over the last few weeks, with sharp volume spikes during pullbacks, suggesting that large asset managers utilizing platforms like Interactive Brokers Trading are accumulating shares whenever the valuation dips. Sector momentum has been highly volatile, with the broader communication equipment index experiencing downward pressure, yet Nokia has managed to maintain a year-to-date gain of roughly 73%. This outperformance relative to its historical peers is directly tied to its recent earnings reactions, where the company reported a massive 54% increase in comparable operating profit, reaching €281 million despite flat top-line growth. This indicates that their cost-cutting initiatives and a shift towards high-margin software sales are structurally improving the underlying corporate profitability. For individual investors using online investing sites to manage their assets, understanding what Nokia actually does today is essential to separating past narratives from current operational facts. Nokia operates through four primary business segments: network infrastructure, mobile networks, cloud and network services, and Nokia Technologies, which manages its extensive patent portfolio. The business model relies on selling advanced routing, optical networking, and fixed wireless hardware, alongside proprietary software licenses that help operators manage complex traffic. Historically, Nokia was the global leader in mobile handsets before completely restructuring its business after the smartphone transition, turning its entire focus towards carrier-grade infrastructure. Older financial reports from a few years ago paint a picture of companies struggling with intense price competition from overseas rivals and low margin profiles on early wireless contracts. However, the recent integration of automated network systems, such as the 6 specialized artificial intelligence software agents developed alongside Google Cloud for routing optimization and automated troubleshooting, marks a clean break from that legacy. Comment below how many shares of Nokia stock you currently hold in your portfolio and whether you are buying this recent dip. Looking closely at the mechanics of online investment platforms, many algorithmic systems and robo-advisors, like Schwab Intelligent Portfolios, look at historical volatility and past dividend metrics to determine asset allocation.
For an individual managing their retirement accounts through Fidelity IRAs or active trading platforms, Nokia presents a highly unique setup because its valuation multiples remain compressed compared to software-only firms. The company currently trades at a forward price-to-earnings ratio that sits significantly below the median of the broader technology sector, even after its massive run from its 52-week low of $4 up to its recent high of $17.45. This valuation gap exists because traditional wireless carrier spending remains depressed, masking the explosive growth happening inside Nokia's data center switching and optical transport divisions. Active traders using the Interactive Brokers platform often watch these divergences closely, looking for moments where an enterprise business segment begins to eclipse a legacy declining division, sparking a complete re-rating of the equity. Looking forward into the upcoming quarters of this year, several distinct future scenarios and catalysts could dictate where the stock moves next. In the most optimistic scenario, the launch of their automated network platform on the Google Cloud Marketplace this September could drive a high-margin recurring software revenue stream that catches Wall Street analysts by surprise. If these automated agents successfully reduce operational expenses for major telecom carriers by optimizing data routing and diagnosing outages without human intervention, Nokia could see rapid adoption across the entire industry. This would elevate their gross margins from the low 40s into the high 50s, forcing institutional models on the Fidelity trading platform to revise their price targets upward. Furthermore, any accelerated spending from massive hyperscalers on optical fiber infrastructure to connect distributed data centers would provide a direct tailwind for Nokia's fixed networks division, potentially pushing the share price past its recent highs towards the $21 bullish target set by major investment banks. Conversely, the risk side of this expectation versus reality equation cannot be overlooked by anyone engaged in self-investing. The primary risk is that traditional mobile network spending from telecom giants stays depressed for longer than anticipated, starving Nokia of the core cash flows it needs to fund its research and development. If carriers continue to delay equipment upgrades due to macroeconomic uncertainty, the revenue declines in the mobile network segment can completely offset the gains made in the cloud and enterprise divisions. There is also the risk of execution delays with their new software integrations, which could cause early customers to pause orders or look towards alternative networking solutions. Investors managing their wealth across various investing sites or using the SoFi trading platform must carefully monitor the upcoming quarterly earnings report scheduled for July 23rd before the market opens, as the consensus estimates currently looking for earnings of 7 cents per share. Any miss on that number or a downward revision in full-year guidance would likely trigger an immediate wave of automated selling, dragging the stock back down towards its technical support levels around the $12 mark. Evaluating the broader investment landscape, the choice of where to place capital often leads retail participants to compare individual corporate turnarounds with diversified funds like Fidelity ETFs or Fidelity mutual funds. While a broad market fund provides stability, individual stock selection based on deep structural changes offers an entirely different risk-reward profile. Nokia is no longer the deep value cigar butt asset it was 12 months ago when it was trading under $5, but it also has not reached the speculative premium seen in pure play artificial intelligence software names. This intermediate positioning is exactly what creates the current tension between wanted expectations and operational reality. The broader market still views it through the lens of traditional telecommunications infrastructure, expecting a slow, cyclical recovery, while the company's internal metrics show an acceleration in high-performance computing connections. To cleanly summarize the central insights of this analysis, Nokia's true narrative is defined by the sharp contrast between its legacy reputation and its current technical positioning. The market expected a slow, predictable hardware manufacturer bound to the budgets of capital-constrained telecom companies, but the reality is a business model that is rapidly embedding itself into the fabric of cloud data centers and automated network software. The recent 5% drop to $13.70 highlights the typical volatility of a stock undergoing a massive corporate transformation, especially as short-term traders take profits after massive partnership announcements. For long-term investors using a Fidelity brokerage account, SoFi Invest, or the Robinhood app to build out an individual brokerage strategy, the key will be watching whether the enterprise and cloud sales can continue to compound at their current near 50% rate. If those segments continue to outpace the legacy wireless business, the gap between market expectations and operational reality will continue to close, structurally rewriting the value proposition of Nokia within the global technology infrastructure ecosystem. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bajes. Don't forget to like, comment, and share this video to support the channel. Heart.